today and investment as it is carried out today by so many millions upon millions of people. But to some degree, we're engaged in a bit of a pyramid scheme here. That, you know, as long as everybody keeps putting money into the market, it's going to do well. But one of these days, somebody may say, "Whoa, bad idea." Am I being silly about that?
No, if we had a town and there were 100 people and we all had 100 houses, we all agreed to sell our house to each other at the end of each year up 20%. We kept doing that, we'd all feel very prosperous. And the problem would be is when somebody left town, and then we'd have 100 houses for sale, and one extra house for sale, and we'd find out what the houses were really worth at that point.
Is that you know, and of course when Warren Buffett talks, a lot of people listen. Is that part of what's wrong with the market today?
No. What happened is, over the last 15 years, stocks have gone up terrifically, in fact, since 1982. There have been two very important drivers of that. One is interest rates have generally gone down, and return on equity in businesses have gone up. Those are very good reasons for stocks to go up. After a while, the very act of stocks going up starts drawing in other people who get excited about the fact that their neighbor made a lot of money, or maybe they made a little money over the past years. And the action of the market itself captures the attention of more and more of the participants as opposed to the businesses themselves. And that's when you get into dangerous periods.
Is that where we are?
We're into that to some degree, sure.
How dangerous a period is it?
You never know. I mean, you know.
No, of course you never know. But
you know that valuations are high by historic standards. You know that the level of speculation is high by any historic standard, and you know that that doesn't go on forever. But you don't know when it ends.
It's gone on for a very long time, hasn't it?
Yeah, but it's gathered a lot of momentum in the last few years. The last 3 years prior to this one, when the S&P has gone up more than 20% every year, that's almost unprecedented.
A lot of amateurs in the game today?
Yeah, and it's, you know, it attracts people.
Well, sure, as long as they're making money.
Yeah. And those people will get flushed out very easily compared to people who really want to buy a business.
Your advice, let's say, to a 25-year-old who's making $25,000, $30,000 a year, but would like to see a little bit more come in over the course of the next few years, how should that person invest?
You shouldn't buy on borrowed money. You should pay off all credit card debt before you buy, because any securities, because you're paying 18% on credit card debt, and you're not going to make more than 18% a year in the market. Then, if you want to pick stocks, stick with the things that you understand and look at them as businesses. If you just feel you want to own a part of American business over a period of time, you just put a little money in every month for the next 30 years into some sort of a group of stocks, maybe an index fund.
Let's take a short break.